Right? Your view of whether Draghi did the right thing by holding firm on rates at the least depends on whether you think this is a temporary correction or something more systemic. What's your perspective, James?
This is tricky. I mean, the violence of the correction would suggest it's certainly not temporary. On the other hand, the absence of the fundamentals to support it suggests it might be. I mean, what we're seeing here is a very strong market reaction against a background of, frankly, very solid global economic growth. Not phenomenal, right? This is not a bullish outlook, but solid global economic growth of 2 to 3%.
So how do you explain it?
Well, as you guys know and report on every day, the markets are not rational. In the short term, very irrational. There's a reason why you have bulls and bears. The animal spirits do reign. Companies that were worth, 40% more 6 months ago, nothing fundamentally changed, have been marked down. Against that backdrop, the thing that is different this time is oil.
But did they deserve to be worth 40% more 6 months ago? There were many companies that just rode this momentum wave. We didn't see a lot of fundamental analysis done. You simply wanted to be long and strong. Even the bears eventually capitulated and got long, and now they got killed for it.
Well, take a sector I'm a little more familiar with, the banking stocks. They were trading at 1.2 book value. Historically, banks traded at 1.25 book value. You bought them, 2.5 you sold them. Trading at 1.2, they're now trading at 0.8. I mean, what happened? What's fundamentally changed to the banking system or the capital base or the liquidity of the banks that would suggest that kind of markdown in the last 4 or 5 months?
Well, banks' exposure to emerging markets, to China, because there has been a global slowdown, and oil.
Banks always have exposure. They always manage their risk. They always mark to market. They always put on hedges. That's our job as banks. And they will take marks and they'll take hits over time. But not at this kind. Stephanie, it doesn't add up to me. The fundamentals don't support this violence. I'm not saying we weren't due for some form of correction, but the fundamentals don't support it.
But markets are emotional. The financial crisis happened just 6 years ago. And so people don't have full confidence back in the market. Many still sit in cash. So as much as you could say, banks do this, banks do that, banks also get really long and really bloated, and they make mistakes at times. So maybe people are just being defensive.
Yeah, but the facts don't support it. I mean, back pre-crash, you could support it. The banks were operating at 40 times leverage. Today, they're at 10 times. The facts just don't support it.
James, most of the people here in Davos have no idea what's going on inside financial markets. Morgan Stanley does. Do you see any of your clients taking risk in size right now?
No. No, we have 7 million clients, so but I don't have access to that kind of scope. But in aggregate, no. I mean, people are skittish. I think Stephanie's point is right. There's a lot of scar tissue from the financial crisis. Throw in the noise about China and throw in where oil is trading, which nobody anticipated. This would take a very brave person to be stepping in at this point. But brave people will step in, and 2 or 3 years from now, they'll look back and have seen this as a buying opportunity.
So is that what you need to see first? Before we see bottom in this, call it correction, right, period of volatility, some people, some clients have to start looking at this as an opportunity and stepping in size.
I think so, but it might be too soon. I mean, we've just digesting the China numbers, 6.9%. Is it really 6.9%? We're now hearing people talk about oil going below $20 a barrel. There's enough uncertainty. I don't think you're going to get a lot of enthusiasm in the short run.
Do you think oil will go below 20?
I don't know. I didn't think oil would go below 50. Let's be honest. Who predicted when oil...
Fantastic point.
Right?
Fantastic point.
Nobody was out there with this prediction. What has happened to global demand that suggests oil should be below 20? It isn't. The facts don't support it. There is an excess of supply that is being pushed out of the system. As it gets pushed out, you see the cycle, the commodity cycle, which we've seen again and again and again, a rebalance of demand and supply.
We look at the massive swings in financial markets, trades gapping, pricing. Much of this, many people say, has to do with DoddFrank and Volcker rule. If they were not in place, would banks like Morgan Stanley be cushioning a lot of this? Protecting customers, some might say?
I don't think so. I think that's overstating it. I mean, what Dodd-Frank essentially did was recapitalize the banking system. And by recapitalizing the banking system, you take away the risk of a run of liquidity. Has that taken liquidity out of the market? Has it contributed to volatility? I'm sure it has, Stephanie, but more on the margin. This is a much more fundamental, visceral, animal reaction to, is the world going to be a safe place over the next several years from an economic perspective?
If more investors are scared, how could that affect your private wealth business, the business that you led really leaning into? And I have to say, all the other banks followed.
Well, it remains a phenomenal business. I mean, our revenues and our profits are up last year. We're up 12% last year. We have record margins and record profits. Transaction activity on a daily basis drops during times of period of stress. But at the same time, we're doing a lot of other things to grow the business with our bank, with our lending products. So I'm not particularly concerned about private banking.
James, all of the European banks appear to be trying to do what Morgan Stanley is doing. Scaling back in fixed income to varying degrees, but scaling back nonetheless, going big in investment banking, going big in equities. What's that going to mean? Is it going to mean that investment banking and equities are increasingly competitive and the business of setting prices in fixed income is going to be left to a small oligopoly of big universal banks?
I'm not so sure it's as straightforward as that. I mean, I don't want to talk about those institutions because they're competitors, they're counterparties, and they're, in many cases, clients. But they're all reassessing their strategic business model given the very real capital changes to the industry. Let's take a basic fact. This industry was operating with returns of 20 to 25% pre-crisis, with capital at about 40% of the level it's at now. Just introducing that new capital brings those returns to 10% or lower. And add in all the other elements of DoddFrank is why they're pushed down to 5%. Everybody sensibly is stepping back from that and saying, what are the sets of businesses that A, we're good at, B, we think are sustainable, and C, have an opportunity to generate returns above our cost of capital? And that is a painful restructuring that's been going on for several years. Yes, we started and we're fortunate we bought Smith Barney at the time that we did. We started relatively early, but everybody's going through the same questions.
If energy hadn't gotten hit as hard as it did, would you be making such a pullback in fixed income? Because when you look at high yield and how hard it was hit, a lot of it has to do with the fact that 30% of the high yield market are energy names. So if we hadn't seen oil get hit like this, would you be making a move to...
Our pullback has nothing to do with energy, to be honest. It had everything to do with the capital requirements to support the business. The macro businesses you need great scale in. The credit businesses are very risk-weighted asset capital intensive. So you put those things together and you say, what is the right mix for us? We're very good at things like structured products, at securitized lending. We're very good at businesses that support our corporate franchise, our M&A franchise, corporate lending, municipal businesses, the core foreign exchange businesses. But there's lots of other pieces we didn't need to be in.
Is it also a way to cut high-cost headcount? Because areas like high yield and distressed, those are traditionally seats that get paid a whole lot of money, more than, let's say, cash equities.
I don't mind people making a lot of money. What we care about is that the revenues are there to support it. So no, we didn't go about it from a cost perspective. We went about it from a business model perspective.
Optimally, what kind of ROE will fixed income generate in the years ahead?
Well, we don't break out fixed income's ROE. We break out the firm's ROE, and we laid out very clear targets. This week, for the first time, we said the firm should be generating 9 to 11% ROE in 2017, and our stock is obviously trading representing a number materially lower than that. We're pretty confident in our ability to get there.
Clearly, it frustrates you, but how do you make sense of it where Morgan Stanley stock is trading versus other banks, versus the index? To many, it doesn't make sense. How do you make sense of it or try to turn this around?
Well, if you look at the largest 6 banks in the U.S., we're either trading number 3 or number 4 at the moment. So how I make sense is that I look at the category. Yes, in the last 6 months, we've had a more difficult time, but I have a time frame that looks longer than 6 months. In fact, if you look over the last 3 years, we've been the #1 performer in the stocks. I'm pretty proud of what Morgan Stanley's done.
Speaking of a time frame longer than 6 months, James, you've decided to stay on as CEO and chairman of the firm for longer. How come?
Well, firstly, the board has to make that decision.
That's true.
I've given an intention with their blessing. I believe that having long-term succession planning matters, and I like to think in terms of 5-year chunks, so 5, 10, 15 years. And I gave the board an indication, I thought, given my age, that a 5-year period felt very reasonable. They were very supportive of that. I wouldn't be near the retirement age at that point. So now that then gives the rest of the organization stability to move forward and for us to do long-range planning.
Might it be longer than 5?
Oh, I don't want to predict that. I just need to. We need to get through these markets.
I was about to say, over 5 years, that's too much.
Yeah.
Somebody who we look to for stability is Janet Yellen. Do you think she could actually change courses this year? She raised rates clearly last year. We're seeing a different picture now.
I would be very, very... If change courses, you mean cut rates?
Correct.
I would be stunned.
Stunned?
Stunned.
Does she have to hold off?
I think she'll be driven by the factors that she's laid out very clearly, which is unemployment continuing to maintain these levels. We may have a four handle on unemployment. This is, by the way, that's extraordinary. We're not talking about that. And also an inflation path to get to 2%. With those, she will raise rates. It is not a zero interest rate economy.
But
right
you
now.
also have a very frustrated America who are sad about jobs and sad about
Angry,
wages.
in fact.
That's why you see candidates like Donald Trump and Bernie Sanders doing so well.
Now, you're not going to try and get me into the political process.
You know
Yes,
what?
I am.
Stephanie.
She isn't. I will. Are you getting used to the idea that Donald Trump may win the Republican nomination?
That's a leading question, Eric, and you know that. Listen, it's great we have this kind of open political process. I think the debates are terrific. People get to observe candidates under pressure, ask difficult questions, and ultimately, this is what democracy is all about. People will make up their mind as to what they want to vote for.
We only get you every once in a while. We've got to squeeze every last bit of juice. And we tried. James Gorman, Chairman and CEO of Morgan Stanley, thank you so much.